One of the problems with the media and what people read about is that everything's based on what's happened in the US. Buy the dip because it always recovers. But there's so many instances outside of the US where the market crashes and never recovers 10, 20, 30 years later.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money, how to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, investor, and a founding partner of Sicard Associates, a boutique investment firm founded in New York City. Join me on this quest to unearth the wisdom of the ages. My guest today is Sophocles Sophocleous. He was born in Canada and raised in Cyprus. He's a Fulbright scholar and CFA Charterholder with multi-year experience in developed and emerging markets in both equities and debt. Currently, he works as an investment advisor to an activist Swiss investor, Veraison Capital. During his career, he has managed individual and institutional equity client portfolios. He worked for a London-based emerging market high-yield debt fund. On an annual basis, he organizes Cyprus Value Investor Conference that he co-founded in 2016. Also, on a part-time basis, he teaches a CFA Level 1 course and a master's course that he designed. We talk about his experience investing across stocks and bonds and developed and emerging markets, founding and running an international investor conference, looking for a dream investment, selling policy for stocks and bonds, similarities and differences, living through a banking crisis. Please help me welcome Sophocles. Hi, Sophocles. Nice to see you again.
Hey, Bogumil. Great to see you. It's been way too long. I'm looking forward to seeing you pretty soon, hopefully.
At your event. And speaking of your event, you were kind enough to invite me to your Cyprus Value Investor Conference a few years back. And you showed me and my wife around the island. And then you also introduced me to many very bright investors around the world. So I've been looking forward to this opportunity to sit down and chat with you about your story, how you got into investing. So let's jump right in.
I got interested when I was a teenager. Okay. And think about when I was a teenager, there was nothing. There was just the library where we'd go pick up, Fortune and Business Week or The Economist. I was actually in the science division. So high school, I was born in Canada, moved to Cyprus when I was 9 and grew up here. And my parents put me in a private English-speaking school because I didn't know any Greek. Of course, I learned Greek, as you know. The way high school works here, there's a business and a science, at least back then. If you were bright, you would go to the science. The bright kids have to go to science, and you can do anything you want. Who wants to go to the business? There's only boring accounting. I started looking at Fortune magazine and Business Week at the library when I was 15. What I did at the time is I actually sent letters to, and this is not emails, letters, like the Philadelphia Stock Exchange and the Wall Street Journal and the New York Stock Exchange. I was very lucky. They sent me a bunch of free material. The Wall Street Journal sent me some free samples and how I'm supposed to read the Wall Street Journal. And it just started from there. Actually, when I went to study at the University of Illinois, I didn't even know you studied finance. I had no guidance. Today, I see parents helping their kids with their applications and taking them to school. Back then, I did everything by myself. I applied for scholarship by myself. I applied to schools by myself. I picked up a bag and left on a plane. No mobile phones, no WhatsApp, no nothing, and just went across the world. And I started off as an econ major, and I had to take a finance class because a requirement. And when I took my first finance class, I was like, oh, this is what I really should be studying. And that's how I decided to double major. I was just sort of attracted to it. I thought it was fascinating. A love affair that stuck with me, and it's a very hard job, I think. People don't realize how difficult it is.
What's unique about your experience is that you were equally interested in the equity side and debt side, and then, in my mind, equally interested in the developed world and in emerging markets. It's pretty unique because people get to usually choose one side or the other, even if they end up doing both. But you've
Well,
been equally pulling the
no,
weight.
I really didn't have much of a choice. It ended up being lucky for me, but it's not like I decided, oh, I'm going to do this and I'm going to do that. When I finished the University of Illinois, because I was on a scholarship, I had to come back to Cyprus for 2 years. When I came back, then the stock market was booming. I got a job working for a brokerage firm. No analysts, just a bunch of brokers. And the head of the firm said, just do research and send it to us. So I did that for about 2 years. The market was crashing. Everyone thought that the stocks were getting really cheaper and cheap. And me, from coming from the outside, to me, it was like, what are these people talking about? These stocks are not cheap. Sort of gave them a different perspective. And when my 2 years were up, this was 2002. And all my friends in the US said to me, no, don't come back to the US because there's no jobs here, recession, blah, blah, blah. And that was actually, if you remember, it's towards that was the end of the bear market. But
Right.
at that time, a friend of mine said to me, why don't you send a resume out to some offshore companies? And I did that. And I got a call from a hedge fund who said, I'm going to come on holiday to Cyprus because one of the two partners was from Cyprus and I'd like to meet. And these guys did emerging market, high yield, distressed debt. And so since people in the US told me I shouldn't go back to the US and this opportunity arose, I took it. And that's how I got into emerging market distress. It's fascinating because I got to travel around the world and we got to do a lot of crazy stuff.
Would you say that the rules, the principles across the board are similar, investing in stocks and bonds and whichever market you're going into?
There's a lot of similarities, Back then, until I guess 2006, but up until 2006, there was a lot of money to be made in emerging market debt just because you didn't have so many investors. So if you think about less liquid, less understood, feared, fewer people covering it. This must sound familiar, right? A stock. No analysts covering it. Something's gone bad and everyone's run away. It's the same thing, right? Same thing. Especially when you're talking about high yield or distressed. Those issues act very much like equity. It's very different when you go into investment grade. So when you go into BB and higher, then it's everything is about the spread to the treasury when you're talking about USD. But when you go to lower grade, then it's very equity-like. But then you had this influx of investors who were crossovers, who were searching for yield, sort of destroyed the opportunity. In the same way it's the same with equity markets, right?
Eventually, there are moments when there's pretty much nothing to buy. Huge parallels. I want to talk about your childhood and upbringing and how that influenced your relationship with money.
My parents worked pretty hard, especially my mother. She finished primary school and she was from a small village and she's working from the age of 12. So they were careful always with their money. I always sort of respected money. My mom finished primary school. My dad finished sort of high school in Nicosia, but that was back in the day. It wasn't really as formal education as there is in more developed countries. So their idea of investing, they bought like a small piece of land, or they just saved up their money. And back then, interest rates were very high. I mean, when we moved from Canada, my dad had sold his business and he was getting double-digit yield from a deposit. It's too bad he didn't lock that in.
For the next 20 years.
Yeah.
So at a different time, but it, in a way, I think influenced your perception of risk and also how careful you are and what kind of choices you make. That's what I'm hearing, and that's what I remember. You and I talked about the Cyprus banking crisis, walking around some ancient ruins in Cyprus when I visited you. And you were talking about the limited access to cash, ATM withdrawals were limited. I grew up with hyperinflation in Poland. Money was losing value overnight. And I think those experiences, we collect them throughout life, but they have an influence on you, on me, they had. And I'm thinking of my American contemporaries. They haven't seen hyperinflation. They've never been in a situation when an ATM cannot give you cash. Can you talk about that? What was it like, Cyprus during the crisis?
You're completely right. I think one of the problems with the media and what people read about is that everything's based on what's happened in the US. Buy the dip because it always recovers. But there's so many instances outside of the US where the market crashes and never recovers 10,
Right.
20, 30 years later. Cyprus, I was actually pretty lucky that I realized there was a crisis. And part of it was gut because things in the Financial Times, reading what a few analysts were talking and saying, and I got to the realization that something's going to happen in Cyprus, and knowing the mentality of management of the banks and the mentality of politicians, there wouldn't be any warning or anything. It would just happen overnight. And so I had moved my money abroad. I put it in Interactive Brokers where I had an account. Actually, I got a safe box and actually put cash into a safe box, right? Because I figured, if the capital controls or something, or I wouldn't have access to money. So if I put some money in a safe box,
Right.
then I would be able to have access to it. And I went to the bank to do a final withdrawal, and the cashier wouldn't give me that last amount of money. So I was like, well, okay, give me banker's draft. The next day, boom, it happened. It was like the next day. I actually felt like going to the bank and saying, I told you so. Of course I didn't. It was terrible for people. There was people that lost a lot of their savings. And some people should have realized it when the yields that were being offered by the bank were pretty high. I don't remember the figures right now, but it was, the yield that was being offered should have been an indication that there was higher risk.
Right.
If you're being offered a higher return, there's a reason usually why you're being offered that higher return. I was lucky. The only thing I lost was a week of sleep because a week before it actually happened, I was thinking about it every night. My father-in-law was a member in one of the parties. I said, what do your politician friends say? He's like, oh, no, everything is fine.
What gave you the foresight to even think about it and worry about it? Was it an experience? Was it a story? Was it a book? Where did it come from that you felt it coming?
I mean, it's these things that happen in emerging markets.
Right.
Right. You see a trend when you go through it a few times, like Argentina, for example, right? Or, you see how the economic development gets worse and how the politicians behave, and sort of see this sort of pattern. At the time, I had already been working for a decade, and seeing sort of things happen. That sort of experience sort of helped me. But also because I had my experience working for 2 years in the Cyprus Stock Exchange, I went to a lot of AGMs. I got a feel for the management, or let's say lack of trust from my end for the management, to a much severe point versus in the US. I mean, Cyprus, especially the equity market, was a wild west.
Right.
There was companies were doing IPOs not to raise capital. The companies were doing IPOs to exit. And what some companies were doing is they were, let's say, exchanging their shares with another company that was going to list. Let's say, my company's listing and I'm a major shareholder and your company's listing. I'll give you some of my shares. You give me some of your shares and I'll just go sell your shares and cash out. And it doesn't look like I'm selling my shares.
Wow.
It's just different games, that type of game.
That makes sense.
I can't really pinpoint it to something in particular. There was no big haha moment.
What I'm hearing is that you've seen it before, you've seen it elsewhere. And when it was happening in your own backyard, you could tell. You could recognize the song, you could recognize the music. And I think the challenge for a lot of investors is that they get so familiar with one market and their imagination is in a way limited and they can't even imagine certain things happening. So the benefit of your experience is that you've seen things happen, and some of them pretty extreme in emerging markets, as you said. But I think it makes you much more aware of not everything has to go the way you thought. And if it doesn't, what do you do about it? And I think that's very eye-opening. I grew up in Poland and I've seen things happen. I've seen a stock exchange reopen after 50 years of being closed during communism. And it was not the stock market that we have in the US. It was more like the 1800s stock markets of Europe or the US. So a bit of a Wild West, as you mentioned.
Definitely.
As a teenager, I remember there was a handful of stocks listed and the stories that were happening reminded me of the 1800s and the railroad stocks in the US.
I think it's the same story in every new market.
Every new market has to go through those growing pains. Tell me about your conference. I mean, brilliant idea. You're bringing people together to a beautiful place, Cyprus. Where did the idea come from? What it's been like as an experience to you?
Yeah, I mean, the conference has been the best idea I've ever had. And how did it come about? I've been to a few conferences. I went to a few conferences abroad. The last one was the CFA London and whatever conference. And I left that thinking, oh, I didn't meet all the type of people I would like to meet, and I didn't get any tangible something I could use. I mean, some of the presentations were very nice, right? But it wasn't something I could make money off of or look into further medium term. So I was talking with a friend of mine, Tim Dutot. Okay, he said to me, hey, well, why don't we put together an event of our own and design it how we would want to do it. And this was 2014 or no, 2015. We didn't do anything. And then I think we decided to do it 2016. It was in the basement of a hotel in Cyprus. The idea was to try to cover the cost. Another thing I forgot to mention is another thing I noticed is how expensive some of these events are. So you don't meet the right people. You don't get anything you can use, and it's expensive. And for me, I wanted to make it cheap. I wanted to bring people I would like to meet, and I want to hear investment ideas. Vitaly Katzenelson actually did this article, what he would tell college students. One of the things he says in his article, which I think is fantastic, surround yourself with friends who are in investing. I said, the conference has been the best idea I ever had because I surrounded myself with smart, great investors like yourself, Bogomil, who came, talked about how they saw investing, not because they were selling their fund, but because they were there to share their ideas and wisdom. And because of this genuine effort from people, I was able to learn a lot. And this also, it opened a few doors for me. It helped me. I got an invitation then to Value X Clusters, where I met Guy Spear and some other very smart people. That's another fantastic event. But there's only very few events of this type. And it's organized by people like myself who are not interested in becoming event organizers. They're interested in becoming better investors and learn. So these aren't really conferences. They're more like small communities of people. And I'm a better investor because of people like yourself who've come to my event. And I live in Cyprus, right? It doesn't matter if you graduate from Harvard or wherever, right? It doesn't matter if you have 5 PhD. The moment you come back to a country like Cyprus, you fall behind. And it's because you're not surrounded by the right type of people. Probably noticed when you came to the event, there are very few active investors. So if anyone's listening to this interview, they're very welcome to reach out.
No, it's a wonderful event. And I think it comes from such a genuine place. And also you were able to maintain a forum through a WhatsApp group, which is probably the most active WhatsApp chain that I have on my phone. People sharing articles or reports or different things, and people from so many places on earth. I don't know how many countries you had there represented when I was there, but over time you were able to accumulate voices from so many places. And it's so helpful because now and then I'm looking at an investment that's outside of my immediate circle of competence, but out there in the world for you and for other friends, there's always somebody that has looked at it or thought of it or had something to say about it. And as you mentioned, knowing other investors, it's very valuable because gives you insights from places and angles that you probably would have a hard time exploring on your own. Yeah, I agree. And as you said, I think there are a lot of events, but yours really stood out to me. And I've been to many and I go to fewer and fewer, but yours is always on my mind. And I'd love to come back at some point and see you guys again in person.
It's also important to have the right type of people, smart and sharing their wisdom or on preaching. And a good example of this, which you've probably seen a lot of, is the whole value versus growth. I don't know if it's been built up by the media probably or by academics. And it's a ridiculous argument. My answer is always what Charlie Munger said. What is value investing? It's smart investing.
There you
That's it. It's
go.
very simple. It's about buying something below intrinsic value. People like the academics who've done all these studies, low multiples, right? What people don't realize is the whole low multiple strategy looks good when you backtest it because of the coincidence of the times where low multiples happen at the same time as discount to intrinsic value. So
Right.
if you're coming out of a bear market, right, and everything sold everything and everyone's disgusted with the market, you'll have low multiples, but you also have a lot of companies with a discount to intrinsic value, which are good companies. Okay. And so then the whole low multiple on its own strategy, let's say, works. But then when you get the bull market starts happening, what happens to the low multiple strategy? It's filled with crap companies. And then there's these people who are like stuck. One thing that we can see from Buffett, but not many people have followed that, is how he himself has transitioned over time. When he even does tech companies now, right? A whole different world. You have to evolve. And if you have people who understand this and people who are also looking to listen, that's where you get, I think, a real boost to everyone's knowledge.
I think there's 1,000 ways to make money in the market.
Exactly.
And the definitions and the labels, I think they're very limiting. I myself own stocks that you would probably qualify as deep value, and I own stocks that you would probably qualify as momentum and growth. It's just the time of purchase and the decision behind it and the role that it plays in the portfolio. So to say that I'll never pay more than 5 times earnings, or I'll never buy anything that grows less than 5% or 10%, it really limits your world. I think everybody makes their own choice. If the things that you buy and own allow you to sleep well at night while you still accomplish the goal of compounding money at a reasonable rate without risking too much, good for you. And people can choose whatever part of the market that they want to be in. So that's the beauty of it. What I love about the market is that the market doesn't care where you are. If you're young, if you're old, what's your gender, what's your degree? The market doesn't care. And I think Munger says that the stock doesn't know that you own it, which I find is a very powerful thing to say.
Exactly. What a lot of investors don't try to do is first, they need to understand themselves. They need to understand what type of investor they are, but not just in the good times, but also in the bad times. How much risk they're willing to take. They don't put the investments in the appropriate compartments. What is this investment you're doing? Is it long-term? Is it short-term? What is your goal? What are you going to do if the stock drops? What are you going to do if the stock goes up? How are you exiting? These are all decisions that you need to think about when you start with any investment, not afterwards. Because afterwards, you're going to be stressed. You're going to make mistakes. Just ride it all the way to zero.
That's painful.
Yeah.
You touched on something really interesting to me, because a lot of attention goes to buying. What kind of stocks or investments do you buy? When do you buy them? How do you buy them? But so little time is spent on selling, which is something you touched on.
Yeah.
What's your selling policy in the debt world and the equity world?
Well, I can say I've made a number of mistakes with my own selling. What happened? Stock went up 50, 60% or something. And I exited because the multiple looked high on a historical basis. Big mistake. I identified the business. I identified the company. I saw the potential, but then I got all hung up on the whole I'm making money and the multiple looks high versus last 5 years, let's say. Big mistake. On the buying side, you just sit on your hands and wait for the right price. If you can, that is, depending on your mandate and or how anxious a person you are. But then on the selling side, it gets more difficult. So for me, it's more, I'm a lot more patient now. And I'm looking for a change in story. And people have to watch out not to confuse a change in the cycle versus a change in the story. With debt, it's a different thing. For example, distressed debt, we buy this debt at, ridiculous multiples. The company would then restructure the debt, the debt would start to trade in range with a rating that would then come along because, when it's in default, there's no rating, no one's covering it. If the company was doing well, then it might go up and become even investment grade. Then it would become an issue. Well, after you get your pop, where is it trading versus where you think they deserve to be rated at? So there's different characteristics for each rating category. Depending on the geography, depending on the sector, you'd make a best estimate there. In many cases, the debt, the bonds would trade towards that rating category before they actually got the upgrade. So once it achieves what you desire, then you get out. With investment grade, it's very different. There's not as much opportunity. There is more of an issue of spread. Sometimes you just get rewarded for depending on the country it's in. So let's say there's an election in a country and people panic and some of the bonds go a little wider. That's an opportunity where you buy the debt. Most of the time, the politicians aren't going to be as bad as it looks. I'd say most of the time that's what happens.
That makes sense. It makes me think of Benjamin Graham and Warren Buffett that you mentioned, especially in the early days, Warren Buffett, where he would buy securities, realize that kind of a gap, whether it was balance sheet driven or something else. And once that was realized, so buying a dollar for 50 cents, once you get the dollar back, you walk away. And in the debt market, that's where the journey usually ends. And with the stock, even if you bought it at a 50% discount, as you mentioned, it became bigger and bigger and bigger. I remember when somebody was telling me years ago that there are no trillion-dollar companies. So I said, well, do the math. How much upside can you have? There are no trillion-dollar companies. And here we are. We have trillion-dollar companies, which is interesting to think about because the definition of a small cap or a large cap has changed throughout careers of 2 decades or so. And I imagine that with some inflation, that definition will change again, but never say there are no trillion-dollar companies because we'll keep on adding zeros and they do get bigger and bigger.
Never say never.
That's the biggest lesson in investing. Never say never. Never say this time it's different because it probably is not. What we've been doing in terms of buying or selling practice is to do it gradually. So we buy gradually and we sell gradually. And depending on the level of conviction, we can really slow it down and build a position over 6, 12 months. And sometimes if it's a slow developing story. So on one hand, it allows us not to cherry pick the bottom because we don't know where the bottom is. But on the upside, we are not parting with all of the shares. So even if we make a mistake in the sense that the upside was bigger, we still have some shares left. But there's a day when I'm selling the last of the shares that we held for a long time. And I feel like, am I going to regret it? Because there's even more upside that I didn't even appreciate in the moment.
I think one of the big mistakes a lot of people do is panic based on what they hear on the macro side. Macro is almost impossible to predict. Of course, there's some very smart macro traders and macro funds that have done pretty well. But for the average fund manager, average investor, if you have a long-term, let's say, compounder, you shouldn't be panicking to get out because, I don't know, there's going to be a recession next year, which might not come for another 5 years. How many times have we heard about recession coming? So that's a big mistake people do.
The market lives through a lot more recessions than the actual recessions.
And people, instead of worrying so much about this, they should spend more time reading 10K of their companies and even of their competitors to their company rather than listening to these macro guru or worry too much about the macro.
It doesn't help. I wanted to ask you a big question that's on my mind. So with our clients that are wealth creators, wealth inheritors, and also our audience, there are moments where even if there's time and preparation, the wealth itself arrives pretty suddenly. So they are pretty much sometimes overnight responsible one way or the other for a large amount of money. What advice would you have for them?
Okay, because I've actually seen this happen to a few people. One of them was a client of mine. One thing I noticed is they'll go into businesses they don't understand. I've seen this a lot. Someone sells his computer business and decides to go into gold mining. They end up losing a ton of money because they don't know what they're doing. One example of this you see in Greece wants to go into shipping because Onassis was into shipping. You're only rich if you're in shipping. Now, it's not about making more money, it's about maintaining that money. So maintaining your wealth. It's avoiding doing anything stupid.
So if they can find a moment where they feel that they can switch comfortably to keeping it instead of remaking it over and over again, it's the moment where the conversation can start and the planning can start. With inherited wealth, it's similar, but also the mindset of now it's here, let's keep it. And at least there's the history and the experience that it took a while to keep it. It took a generation or two or more to maintain it and let it grow so it keeps the purchasing power. Let's not do anything quick, irresponsible now that would undermine sometimes 100 years of history. But it's easier said than done. And I'm always curious to hear various perspectives. So I appreciate yours. I want to talk about success. So the investment field is a field where everything seems to be quantified. There's a number. And I'm curious about your definition of success. Is it a number?
No. It's not a number. I guess, one could go back and say, is Buffett, Bezos, Musk, or any of these people, are they successful? I mean, I guess if you were to count in money terms, I mean, yes, right? In money terms. But, one thing we all have the same of is time, right? On average, all of us, right? There's 365 days in a year. So let's say you make billions of dollars, but, you're working all day and you're not seeing your family. You're not enjoying your holidays. You're not enjoying the weekend. You get older then at some point, okay, you become multi-billionaire, right? Have you been successful? Maybe to someone that's success. To me, I don't see it that way. Everything, success, it's all in our heads. It's an idea. If you think how many people are in misery, how many people struggle to get by. Me, I'm successful if I'm making a decent amount of money where I'm comfortable to be able to offer the things I'd like to my family within reason. That does not mean buying my kids a BMW, for example. What it means to me is being able to take my kids on holiday. I have a health problem, be able to go to the doctor. I'm a lot more down to earth with regards to the whole success. My son who's 9, he's always looking at all these rich people. And he's like, oh, dad, this and that. There's always going to be someone who's smarter than you. There's always going to be someone who's richer than you. There's always going to be someone who's poorer than you. That's a very nice car that guy has. I'm fine with that. Keep looking at your neighbor next door. You're going to be miserable. And there's people like that. They make money and it's never enough. Is that successful? I'll leave that up to you. I hope you. This is my philosophy. It's all in our head. And I've tried to actually talk to people about this, but I guess you have to come to your own realization about it. And I don't know, maybe because there was a time I was working on my own and I was actually struggling. That's helped me appreciate when I had something more steady going on. It helped me a lot to appreciate.
That makes sense. Do you have any book or podcast recommendation for the audience? Anything you're reading these days or a book that made an impression on you that...
There's so many things to read and listen to. I really like the latest edition of Valuation by McKinsey. A pretty interesting book.
Nice.
Richer, Wiser, Happier. That was a pretty good book. And for something more zen, Vitaly Katsenelson has a new book out. What's the name of that?
I know the book.
Not about investing.
It's more about his life.
Yes, I thought that. Oh my gosh, I'm trying to remember the name of the book. Yeah, I thought that was a good book.
Oh, let's see who finds it first. I have it in my Kindle. I thought I had it in my Kindle.
Soul in the Game. Soul in the Game by Vitaly Katsenelson. Yeah.
Soul in the Game.
Yeah.
Great book. It introduces the journey of the investor and becoming an investor in his life. I think it's a fairly unique way of finding out about investing.
I would actually even recommend people get the audio version.
Oh, yeah?
Yeah, there's an audio version, and I listened to the audio version. There's a lot of good stuff there. Otherwise, the other thing I would say is to people, don't spend too much time reading and reading and reading. You have to think more about your own investment strategy, what you are comfortable with. One thing that I've learned over the last 20 years is that the best investments are usually obvious. And Munger say there's the easy pile and the hard pile.
Let's stick with the easy pile. Also, I like to think that anybody interested in investing doesn't have to immediately buy individual stocks. You could become an owner of businesses through a simple thing as an index fund and put a little bit of money regularly. You don't have to time the market.
Exactly.
You just have to gradually do it. And over time, if you feel more comfortable, you can supplement that approach with a stock or two or eventually a portfolio. But the starting point is become an owner of businesses through public market that way. And don't try to time it. Don't do it when everybody's doing it. Do it regularly and good things will happen. That's how I look at it. Thank you so much again for today. I really appreciate it. You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski. The content of this podcast is for general informational purposes only, and so are the opinions of members of Seacard Associates, a registered investment advisor, and guests of the show. This podcast does not constitute a recommendation to buy or sell any specific security or financial instruments, or provide investment advice or service. Past performance is not indicative of future results. More information on Seacard Associates is available in its Form ADV disclosure documents available at advisorinfo.sec.gov.